China is laying siege to the US dollar and the US economy as a whole, and the effects are starting to mount. It is now clear that this isn't just some small action the Chinese Communist Party is making as an attempt to boost their economy. It is tantamount to economic war as the CCP takes aim at US hegemony. And at the center of America's power lies the US dollar, which is why it's so instrumental with regards to China's plan to destroy the United States. Now, for years, people laughed at the idea that China could even hurt the US dollar. But when we look at what's going on right now, China is actually succeeding in its plan. They are dumping treasuries, pushing up US costs of borrowing, and making it harder for the US to fund its monstrous public and private debt burdens. BRICS nations are openly building up systems to compete with and replace the dollar, from new payment networks to currencies backed by natural resources. And the Treasury market is cracking. Foreign demand, even setting China aside, is drying up, causing yields to surge. The world is watching as US financial dominance starts to slip faster than anyone ever expected. Housing markets, bond markets, equity markets, even alternative investments will be impacted by this massive shift. And if that worries you, I don't blame you. It worries me too, which is why I've built a business helping experts, enthusiasts, and educators build 100% online coaching and consulting businesses. My business Grow Coach helps you turn your knowledge, experience, and expertise into six-figure online coaching and consulting businesses. We've worked with people in all kinds of niches, from maths tutors and career coaches to fitness trainers, relationship coaches, and property investors. And I even went ahead and made a free guide for you explaining how the industry works and how you can build your own online education business to 6 figures a year. You can download that free guide in the link down below in the description. Now, China's plan starts with America's problems with the Treasury markets. Now, there's no secret here, but yields have risen to multi-year highs of almost 5%, the highest we've seen in over a decade. The reason for this on the surface seems simple. Massive government deficits, borrowing an extra 6.5% of GDP every year, despite growth being well below that. The US is spending ludicrous amounts, literally trillions now, just to pay off the interest on that debt, to the point where the 10-year rate jumped by 100 basis points, even as the Fed cuts interest rates during late 2024. There's lots of market stress contributing to this as well. Instability with regards to Trump's tariffs, and no one knowing which ones are here to stay and which ones are just negotiating tactics that won't last more than a couple of weeks. This concern is changing a multi-decade long trend of foreign investors, private corporations, and governments and individuals flocking to US treasuries for stability starting to unravel. Foreign investors hold more than 1/3 of all US treasuries, to the tune of about $9 trillion, but that number has been reducing, meaning less capital seeking those super safe bonds. The US reached that peak a few years ago of more than 1/3 of all US government debt being held by foreign investors, but that's now been declining over recent years. And on top of that, who the foreign investors holding US debt actually are has been changing as well. China and Japan alone, only their governments used to make up about 40% of the foreign investors in US treasuries, but that's now dropped to only 25%. Now, that may seem normal, but it really isn't. Take the UK, for example. Not a very strong economy, not a stable government, yet foreign investors in UK government bonds has risen from $200 billion around a decade ago all the way up to $740 billion as of today, meaning the number of foreign investors in UK government bonds has tripled, while for the US the number has actually been going down. The exact same situation is going on in Europe as well. Not a strong economy, stagnant growth, over-regulation causing a lack of innovation, a continent troubled by existential crises like the war in Ukraine and overwhelming levels of immigration. Yet, foreign investment into Euro bonds has risen from $900 billion to $1.5 trillion in recent years. Even steadfast allies of the US are more cautious than ever when holding their treasuries. The United States' decision to weaponize the dollar against Russia following the war in Ukraine makes countries nervous. Even if Germany isn't about to go and invade Poland again, it is entirely feasible that Germany does something else to annoy the United States enough to warrant some kind of financial reaction, and the more US treasuries a country holds, the more susceptible and weak they are to that kind of reaction. All this basically means that foreign demand for US treasuries has been stagnant over the last decade, falling in terms of US GDP growth and actively falling over the last year in particular. Now, in particular note though is the actions of China, as they are of course the second largest economy in the world, the second most powerful country militarily and politically too. and their economy is still growing rapidly as a result of there still being literally hundreds of millions in the country who haven't really entered the 21st century yet. The Chinese government is holding its lowest amount of treasuries currently since 2009, just 750 billion US dollars, almost a 50% reduction from its peak, and the speed of China's drawdown in treasuries has been accelerating, in particular over the last couple of months. Now, numbers are finicky here and we don't have the exact figures for recent months, but it seems to be somewhere in the region of about 10 billion US dollars per month reduction at the moment. This hasn't been done in sudden dumps, but more in a slow and steady fashion, simply letting old bonds mature and not buying up new ones in response, which has helped to keep media attention off this event. China, of course, claims that this is really just a diversification of their reserves, or they're out there looking for higher returns somewhere else. But China has also been doing something interesting with the treasuries it continues to hold. It's been moving them to countries outside of the US, to places like the UK and Belgium and other offshore centers. Now, over the last few years, I've realized that there's essentially been a revolution since the pandemic in the online education industry, to the tune that it's now worth more than $200 billion a year. And it's all based on experts and enthusiasts selling their knowledge, experience, and expertise to those who want to learn online, essentially building their own fully online consulting or coaching businesses. And that's exactly what my business, Grow Coach, helps people do. Coaches in this industry aren't limited by geography. We can sell to anyone, anywhere in the world, and we can leverage the Zoom revolution to do it whilst this opportunity is thriving. Now, I made a 100% free guide and free training explaining exactly how this industry works and how you can take your information, experience, and expertise and turn it into a six-figure online business without having a single subscriber or ever posting a single video onto YouTube or social media. Whether you've thought about online coaching or consulting before, or if you haven't even heard of it before, my free guide and free training will explain everything for you, and it's entirely for free, so you can download it in the link down below in the description. Now, why is all this happening with China reducing their holdings of US treasuries? Well, there's a bunch of reasons, but the key one is the US-China trade war. China is being targeted far more than any other country because of their massive growth in recent years, and this isn't just about the trade war over 2025. Trump launched a load of tariffs on China back in 2018 and 2019, 25% on about $360 billion worth of exports. Biden actually maintained those tariffs and extended some of them as well. And then we have the new developments with Trump's presidency over the last best part of a year, which have been far more aggressive than before, with tariffs peaking above 130%. Now, this has all made it pretty clear to the Chinese Communist Party that they are being singled out and targeted directly in an attempt to damage their economy, and it has worked. Chinese exports to the US have plunged after these tariffs, and supply chains have started to realign away from China, with companies moving production to other cheap labor countries like Vietnam. So China has to fight back. They can't appear weak on the world stage, and they can't allow the US to damage their economy without hitting back and hurting the United States, or else these tariffs will only get larger and worse. Their vocal attacks have been tariffs of their own, retaliating against the United States, responding with tariffs right back at them. Say the US launches a tariff of 30% on China, well, China will just launch them straight back at them at 20%, a little bit less as an attempt to de-escalate without appearing too weak. But China exports far more to the US than it imports, so with a tariff war, they are always going to come out hurting more. And so they've been looking for other opportunities to hit back by targeting the US dollar itself and not just American exports in isolation. China is now actively selling their treasuries as an act of economic war. They currently hold less than 3% of global treasuries, when that number used to be as high as 14%. And for a while, this was difficult for China. They needed US treasuries on their books for their own interests. They maintain a cheap yuan to ensure that manufacturing in China is more competitive than other nations, but they can only do that by printing Chinese yuan, selling them, and buying up foreign assets instead. And the vast majority of those foreign assets, well, they were United States based, which helps the US. It boosted their asset prices and reduced the cost of their debt, but no longer. China is replacing its US assets with other foreign assets, allowing them to still manipulate their own currency, allowing them to remain competitive as a manufacturing hub, but without aiding the US dollar. But China's plan doesn't stop their war. They're teaming up with other nations to increase the effect of their attack. They've been rallying other BRICS nations and helping BRICS as an organization to grow beyond its original 5 member states to destabilize the dollar. Whilst BRICS nations can barely be considered allies, China, Russia, and India, all vying for power, are more than happy to hurt one another. They do all share the same interest in hurting the United States and reducing their influence. They've even literally said that one one of their aims is to displace the US dollar from its entrenched role as world reserve currency. So they've been building parallel financial frameworks to bypass the old Western-dominated channels. The new development bank was created as an alternative to the World Bank, and they created the contingent reserve arrangement as an alternative to the IMF. They're providing funding to developed economies in their currencies instead of US dollars. BRICS nations are also actively trading with each other in their own currencies as well, which may seem like that's a no-brainer, but the reality is that in the past, if Russia was to sell oil to China, that deal would be priced and paid for with US dollars. Saudi Arabia, though, now prices and sells its oil to China in yuan, completely bypassing the US dollar altogether. India is running more and more of its trade with partners in rupees, with an aim to run everything in rupees within a few years. But the biggest threat against the US dollar comes from the BRICS cross-border payment network, BRICS Clear Settlement Program, and a potential BRICS currency altogether. BRICS are building an alternative to SWIFT to allow them to completely circumnavigate any sanctions levied to any member countries by the United States and the West. In essence, they're taking aim at every aspect which the US dollar dominates, not just avoiding buying up new US treasuries, but by trying to eliminate the petrodollar, by trying to bypass US-dominated financial systems, and by ignoring the dollar altogether when it comes to helping developing countries grow. All of this serves to reduce the power and influence the United States has across the world, to grow the power and influence that China holds. BRICS now make up about 40% of the global population and almost half of natural resource production in the world. All of this hurts the United States, and it's hurting them now. One of the reasons the US has been able to print so much money for decades on end without having hyperinflation is because the demand for the US dollar expands so far beyond the US itself. If China wanted to buy oil, they needed to buy US dollars first. If Nigeria wanted a loan, they had to get it in US dollars. That extra demand meant the US dollar itself basically became an export for the United States, allowing them to inflate the money supply, print more dollars, and sell them overseas without causing excess inflation for Americans. And the massive reliance of the rest of the world on United States debt made the same thing. The government could take out as much debt as it wanted as there was so much demand for it, and that interest on that debt was low, and so it was basically free. The lesser the demand for US treasuries, the lower the value of those bonds, and the higher the interest rates, meaning that free money is drying up. The US pushed their luck. They weaponized the US dollar to too great an extent that other countries started thinking twice about their reliance on the dollar. There used to be confidence and a confidence premium in the United States and everything associated with it, giving asset prices higher values because it was all backed up by the single most important currency and economy in the world. But that is waning, with even JP Morgan taking note of this and saying that that premium is being eroded away. Every time the United States attacks the financial stability of Russia, Saudi Arabia and China take note, and they act to make sure the same thing can't happen to them. The US basically has overplayed its dollar hand, and it's starting to hurt, and this doesn't just hurt the US government, it hurts the US economy and American people as well. Debt markets are global, and the massive sustained influx of capital from other countries meant American citizens had access to incredibly cheap debt, just like the US government. And that debt, to be perfectly honest, was incredibly productive for the United States. The tech capital of the world, Silicon Valley, had been funded by ridiculously cheap capital that allowed it to invest at a greater rate than any other place in human history. But as debt service costs rise and these costs stay high, as we've seen, the investment, innovation and growth that came with that debt gets reduced, and so the American economy hurts. Cheap car loans, cheap mortgages, cheap credit, they're all a thing of the past, meaning Americans will just have to pay more to live like they always have, and this all stems from direct action from countries like China. Now, of course, not all of the falling demand can be traced to China and other BRICS nations trying to fight the petrodollar. Japan used to be the single biggest holder of US treasuries in the world at one point as well, but their demand for treasuries has been falling too. Their high inflation rates are causing panic and forcing Japanese interest rates to rise. The yen carry trade, where Japanese investors would borrow in yen, then invest in dollars, has started to unwind as a result of those higher interest rates too, and the increase in the value of the yen has caused many of those carry trade investors to actually lose money on what they thought was a risk-free investment into American assets. And there's the impact of de-globalization to consider too. Countries are desperate to become more self-sufficient, to grow more of their own food, produce more of their own products and protect themselves from supply chain disruptions or geopolitical risks, and with that comes a lesser demand for the US dollar than we used to see. China isn't just selling treasuries though, and it isn't just doing this to help their economy. They are pulling away at the threads that have kept the US on top of the world for almost a century. Add on to that the growing influence and partnership of BRICS, de-globalization, a massive debt burden, and Japan's retreat from US treasuries, and the cracks in the dollar's dominance are literally impossible to ignore. The US dollar was once untouchable, but that era is over, and it would literally take me hours to sit here and cover every single market, every asset class, and every investment that's going to be impacted by all of this. So if you want to build a second income or full-blown online business to protect yourself from this global shift that we're seeing, download my free Grow Coach guide from the link down below in the description. If you're an expert, an enthusiast, or an educator in literally any niche, any industry, no matter how small you may think it is, you can build an online coaching and consulting business with nothing more than the information you already have, without needing a single follower on Twitter, a single subscriber on YouTube, or a single view on any other social media platform. We've helped people build six-figure online incomes in countless different niches, from maths tutors and career coaches to fitness trainers, relationship coaches, and property investors. So if you want to learn more about this $200 billion a year online coaching and consulting industry, you can download the free guide in the description down below and watch the free training alongside it.